So Europe is in a very terrible place, and by now we know the situation. The continent has an industrial crisis. Companies like Volkswagen, they are moving to close their production plants. Even the German government collapsed thanks to a budget crisis. But things can actually get worse. The bloc's currency, the euro, has collapsed to a 2-year low after disappointing PMI data. The overall economic output is down, but we can really see the crisis in the manufacturing sector. For over 2 years, manufacturing has been clearly in the contraction zone. Orders just aren't coming in, and the entire sector is still shrinking even today. And now this crisis is spreading towards other parts of the economy. Services are also down, people in Europe are suffering, and domestic consumption isn't recovering either. Most importantly, the euro is already showing extreme signs of weakness, and this isn't good for Europe that's facing a Trump presidency in 2025. Sure, the whole world will be affected, but the US is the biggest patron of the Europeans. If exports to America drop further, this could crush the currency into dust. Understand how serious this is. As the currency continues to plunge, this opens up a whole can of worms for all the 27 member states. Traders are betting on a big rate cut from the ECB in December. There's a 50% odds of a big 50 basis points cut. You don't cut rates aggressively if your economy is strong. You cut it because the economy is weak. Europe is using financial engineering to solve a problem that revolves around the energy crisis. You throw in a collapse in PMI data, the euro fell again by more than 1%. This plunges the EU into a new currency crisis. The euro is back to the November 2022 levels, and this further in turn drives the wheels of deindustrialization. When the euro collapses, it hits the bloc with two serious effects. Firstly, real wages in the bloc are going to drop even further. People's buying power is going to collapse, especially when it comes to imports. Europe's imports are beginning to rise much faster than their level of exports. We can see an increase of 3.4% in Q2, while exports went up by only 0.7%. The balance of trade is also starting to shift downwards. Q2 surplus came in at only 40 billion euros, which is 15 billion less than Q1. So goods from the US and China are going to cost more. Consumers will have to make budget cuts, which will impact the local economies. To buy that laptop from China that's more expensive, you'll have to skip afternoon coffee at your favorite cafe. Like China and Japan, many countries in Europe are export dependent. Countries like Germany, they push out their cars. France exports planes and all those luxury products. The issue with a collapsing currency is now all the inputs start getting more expensive as well, chief of which is imported energy. The horrible policies in the EU will get magnified as the euro continues to plunge further down. Just 2 days back, one of Germany's biggest energy companies wrote a shocking statement. Their CEO wrote a statement that underscored how bad energy prices are getting. And here's what he said. In the evening hours of November the 6th, the price of power rose quickly and sharply to more than 800 euros per megawatt hour, 10 times more expensive than usual. These very high prices are certain indication of the state of energy supply in Germany, the result of the shortage of supply. Europe's biggest economy faces an unstable energy system, and this makes it hard for the Germans to stabilize their manufacturing sector. If power prices can spike 10 times in a day, in a night, how can you control the cost of manufacturing? You can't. And this can even drive smaller companies out of business. This problem can be seen clearly in Germany's energy mix. Nuclear energy in rate is almost non-existent, and in 2024 and onwards, this number will drop to zero. Renewable energies make up the bulk of power generation, but this includes solar and wind energy, highly unstable sources that aren't really reliable. The remaining amounts comes from non-renewable energy sources, and this includes oil and gas, a ton of which, like LNG, are imported from the US. And because the euro continues to collapse, the cost of energy imports, they're going to rise. So overall manufacturing costs are going to escalate even further. Realize what makes a currency strong or weak. When there's a greater demand for the euro, when people around the world acquire more of the EU currency, it strengthens. And when people don't, the currency tends to fall. And why would people want euros? To import stuff from the Eurozone countries. In 2023, the euro was the most used currency for EU exports. 52% of EU products were sold in euros, compared to just 32% in dollars. So if Europe can export more to the world, the demand for euros will increase, and that strengthens their currency and helps bring the cost of imports down. In other words, the standard of living for people in the EU will rise. But now the EU exports are collapsing, especially with higher energy prices. This is going to hammer the euro down even further. But the story, guys, gets worse. In 2025, the US economy is going to take a very dangerous protectionist turn, and this is going to hammer global currencies all over the world, including the euro. All indications show that the US economy is moving to strengthen the dollar while trying to bring manufacturing back home, and both of these are very bad for Europe. Trump wants to appoint Scott Bessent as the new US Treasury Chief. He's going to replace Janet Yellen, and this has very big implications. Firstly, Bessent is a strong supporter of Donald Trump's tariffs, so it's very likely he'll execute Trump's plan to clobber the world with a 10% baseline tariff, and that will target the EU economy as well. And it goes without saying that Europe needs to export to the US. Competing with China for global demand is becoming impossible. But if Trump closes off the US market to foreign manufacturers, this is extremely horrible news. In multiple interviews, Bessent has confirmed he wants the US dollar to strengthen against other currencies. He has confirmed this multiple times. US economic policy would eventually result in a stronger dollar. Tariffs also help strengthen the currency. And overall, a weak dollar policy isn't coming. And it's critical we understand how this is possible. By imposing brutal tariffs, Trump can lower the demand for EU goods in the US, which is the biggest consumer market in the world. Interest rates in America could continue to stay high to fuel demand for dollars. Meanwhile, the euro could collapse further because manufacturing gets less and less competitive. The depreciating currency isn't enough to make up for higher input costs like energy. Besides tariffs, the US is also moving to cut their budget deficit. This is a very shocking move that could make the dollar soar even higher. The current budget deficit is at 6.2% of US GDP, and by all measures is insanely high. Bessent is going to help bring this down to 3%. This will be done by deregulation, energy dominance, and reprivatizing the economy. And that means growing the US economy much faster than the debt burden. He also wants to turn off the Inflation Reduction Act, and this would mean over $500 billion of spending will be reined back in. Now, there are many other examples of Bessent being a fiscal hawk. He wants to slash spending, which is positive for the US economy. But it's terrible news for the euro because they need the dollar to be much weaker. The US is going to use trade tariffs to force the world to buy stuff made in America. At the same time, Trump wants to cut down on spending and strengthen the reserve currency. The headwinds coming for Europe is tremendous, and it all depends on how much the US decides to slash the deficit. If everything goes to plan, Trump will reduce the deficit to 3% of GDP, and that will mean a 10-year savings of $8 trillion. In other words, the US government will be spending $800 billion less annually for 10 years. The most immediate strategy is for Trump to adopt Elon Musk's plan of cutting away federal workers to fire a ton of government workers. And if that's the case, it would mean fewer dollars flowing into the global economy. People have less money to spend and dollars suddenly get more scarce. The national debt will still snowball higher but at a lower rate than what we are used to. And this alone could trigger a dollar shortage in the world. In the EU's case, this means the euro might be headed for a deeper plunge in 2025. The outlook isn't good and the effects will hit their industries and GDP as well. This chart shows us the victims of the coming US trade war. The US has the biggest trade deficit with China, but the second biggest trading partner is the EU. The bloc earns over $200 billion in trade surplus from the United States, and half of this amount is invoiced in euros. If this demand disappears, transactions in the currency will plummet. So the situation is extremely dire for the Eurozone. Trying to reverse the currency plunge is going to be very difficult. Brussels have made many missteps that they probably can't recover from. They confiscated Russia's assets and over $1 billion have been transferred to Ukraine. So trust in the financial system has taken a serious hit. It's a self-inflicted wound. The effects from the US are serious enough, it's very bad. But if we shift focus to what China is doing, we can see this impacts the euro as well. We know China is de-dollarizing their trade. Instead of using Western currencies, Beijing is settling transactions using the RMB instead. And because of this, even fewer euros are being used in global transactions now. Even within the SWIFT system, the Chinese yuan has surpassed the euro in trade finance, 5.7% versus 5.6%. It truly tells you how far Europe's currency has fallen. Demand for the euro is starting to drop more and more. Trying to tariff China into submission isn't going to work. They would just sell to other countries around the world, which means even less demand for euros from China. The story in 2025 is going to be very bleak. Unless Europe turns their economic situation around, the currency is going to get clobbered further. If the euro continues to slide past a certain point, it would decimate more and more of their critical industries. Raw materials will get insanely expensive. Over the past 20 years, the percentage of EU imports from China has been increasing, but the biggest jump is coming from high value products. We are talking about telecommunications, machinery, and vehicles. This disparity will only grow because EU manufacturing won't have the ability to manufacture cheap goods for their local consumers. And just like Japan, a weaker currency doesn't always translate to more competitive exports. When you are importing expensive energy and your cost of labor is still insanely high, it's still a net negative. Europe is about to face economic hell in 2025. They are sandwiched between a rising China and a protectionist America. But let me know what you think. Can Brussels somehow save the euro? Or will it continue to collapse even further? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.